Okay, so welcome all to our I-month event, right? So this is from the Faculty of Science, and I think throughout this week, you can listen to some of the science talks offered by various faculty members of the department, of the faculty, right? So that you can have more understanding on the various different subjects, right, in this Faculty of Science. So today's talk is given by me. So I'm David Lee from the Statistics and Actuarial Science Department, which is one of the departments in the Faculty of Science. So in this science talk, right, so I'll talk about something on the interest rates. So hopefully you find something interesting in this talk that probably inspires you to find more information about our department and also our programs. So now our department's webpage I will put on the Zoom chat. Just give me a second here. Yeah, so I have um, input the link to our department's webpage, which in this particular page, you can find the different programs offered by our department. So you can check that out later after the talk. All right, so obviously I'm going to talk about the interest rates in this talk, and here we'll talk about the various things, right? Why interest rates are needed and what are they for, right? So why would we be interested in changes on the interest rate, and how is it going to affect our economy? Okay, so yeah, hopefully you all know a little bit, right, about interest, about the amount of interest that you are going to pay if you borrow money, or if you lend money out to others. You probably would be expecting your counterparty, right, or the person um, to whom you lend the money to, right, will give you some interest. Okay, so interest in a very simple words, right, would be basically the money or compensation to the lender for using his or her money. Okay? Now, obviously, if I have the money, it makes sense to think that it is always better for the money to be in my pocket than actually I lend out the money to others, right? So if I'm lending out the money to another person, um, well, if it is a friend or relative, maybe not that much. It doesn't matter too much. But if it is to a stranger, then obviously you do not prefer that. Okay, and now in order for you to be willing to lend out money to other people, right, you would definitely want some compensation or some um, money in return of your sum that you lend to others, right? So that is the why we are interested in the interest, right? So basically, why we are interested in talking about interest is because um, of the necessary ingredient for any kind of transaction of money um, between individuals. Okay, so especially in the form of lending, for example, if you take out a loan. Okay, now so depending on the party you are looking at, the interest can be regarded as a cost of borrowing, obviously for the borrower, right, for being able to use money that does not belong to himself or herself. And now, in the other perspective, for the person who lent out the money, right, then it is the reward, right? It is kind of the return of the investment. Now, so yeah, depending on which perspective you may find yourself in either of these situations, right? So you might be a borrower for in a particular situation, and in another situation you might be the lender. Okay, so it really depends on the perspective. Right. Now, so whenever we have cash, whenever we have money going from one person to another, right, this gives rise to the concept of a cash flow. Okay, so it's either flowing in, right? So it's using yourself as the perspective. It is either flowing in or flowing out. So any cash flows will have three properties that will be of interest when we study for example, in finance or in a mathematical treatment of the different inflows and outflows of money. Now, obviously, the amount is important, right? So this one I think is kind of intuitive. Now, the uncertainty is also important, right? Especially if it is something into the future, you don't know whether you actually get to receive or pay that money. Well, maybe for pay you can control, right? But whether you can receive a certain sum of money in the future might not be that obvious, all right? And the timing is also a very important part of of the properties about the cash flows, because the timing will directly affect how much it is worth now because of the concept of interest. So we'll talk about that concept a little bit later. But just bear in mind that for any cash flows, there are three ingredients that are important for us to consider: okay? The amount, the timing, and whether it is to be paid or not. Okay? So the uncertainty associated with that. Now, so one very obvious example you can think of and direct application of interest is if you put in a time deposit with a financial institution, most probably banks, right? So now a time deposit is a form of deposit that is sort of locked in for a certain period of time. So, for example, if you are depositing in a 3-month time deposit, then that means you cannot get the money out in that 3 months. Well, you can, but then there will be a penalty, right? But after the 3 months, we say that the deposit has matured, and at that time you can get back your amount, right? Your amount that has essentially you lent to the bank, and also interest. And how much you get, right, to compensate for you being lending the money to the bank is here, right? So here these rates um, I searched online a little bit earlier this month, and you can find that for a 1 month time deposit, you get only 0.25% interest. And by the way, this is denoted as PA, which means per annum or per year. Okay, so the interest rate is 0.25% a year. So if it is 1 month, then you have to adjust for the period accordingly. And how to adjust, we will talk about that a bit later. Now, if you are willing to put into the bank the money for 3 months, you get 0.50%, or 0.5. And then 6 months and 12 months are all a little bit higher, but only 0.55. And this requires at least $50,000. Now, you may ask, right, why is there a difference between the period and the interest rate? And maybe you have some ideas already, right? So if I'm putting in the amount for only 1 month, that means I can use my money after 1 month, right? If I put in the money to the bank for 12 months, then I cannot use my money for 12 months. So so that's the kind of cost, right? You have. Oops. So I think I have to, let me see, clear all the, okay, clear all drawings. Yeah. Okay. So yeah, you do not have the flexibility, right, for 12 months. Okay, so that's why you are, let me see. So, okay, I have to clear the drawings again, I think. Okay. Yeah, so I mean, this flexibility is important, right? Because if I can use my money sooner, right, then, well, obviously, so I need to find a way to disable drawings. Let me see, annotate. Okay, yeah. So I hope that it works now. Okay, yeah. So that's why you are going to get a higher interest rate, well, per annum, right, per year, right? If you are willing to put in your money with the bank for a longer period of time. Okay, and as you can see here, right, the interest rate is quite low, really, right? So even 0.55% is like if you put in $100, you don't even get $1 at the end of the year. Okay. Okay. Now, so just now I showed to you some interest rate. Okay, so how do you actually calculate interest, right? And now, so interest, as we mentioned before, it is the price that you pay, right, to use a certain sum of money that you have been, I mean, you borrow from somebody else, and this amount, I mean, this price or interest is can be expressed in two ways. The first way is the monetary amount, and so the actual amount you pay, or I mean, yeah, the actual amount you pay for borrowing the money. So that will be your accumulated value minus the principal. Okay. Now the principal is the amount that you borrow, right? So just think about yourself as the borrower of the money. Then it will be the amount you borrow, which is called principal. And for example, it is $10,000. And then the accumulated value is the total amount that you have to pay back at the end of the period. Okay? So here I'm assuming that it is 10,150. Now the difference for that will be the price, right? So the difference for that between these two numbers will be the price you pay, right? In order to be able to use this borrowed amount of money. And the interest, obviously, the difference would be 150. Now, so this is the dollar amount of the interest you pay. Okay? But more frequently, we talk about the interest rate, which is a percentage, just like the rate you saw a little while ago. Right. So this is simply a percentage of principal. Okay. And the interest in the previous slide was $150. You divide it by the amount of principal you started with, and then multiply by 100%. So in this case, it would be 1.5%. And now this might not be per annum, right? Because I didn't specify the timing of your repayment of your borrow amount, right? So if you repay 1 month, I mean 1 year later, and you are paying 10,150, then this will be the interest rate per annum or per year, right? Otherwise, you will have to do some sort of conversion. So typically we quote interest rate in a percentage because we don't want the principal to affect our our size, right, of the interest. Okay, so that makes it easier to communicate to other people. Okay, so I mean the interest rate is easier, right? Now, so in this graph, you can look at the interest rate, right? So how it evolves through time. Right, so I'm giving you the interest rate, which is the interbank offered rate. So the interest rate among the banks in Hong Kong, right, between 2006 and currently, okay, 2020. And you can see that in the first couple years here, right, 2006 to 2007, the interest rates were pretty high, right, like 3 to 5%. And the different lines represent the length of time, right? It's kind of similar to what I showed you, but not exactly in that notion. But overnight is the shortest, right? It's just 1 day. And then you have the 1 month and the 12-month offer rate. So usually the 12-month rate would be higher if you are using our previous logic in determining the interest rate. But you can see that this is not always true. Okay, so it used to be quite high, right? But then in 2008, well, we had a financial tsunami happening at that time. So I mean, some major financial institutions collapsed in the U.S. And that sort of affected the stability of, the financial stability all over the world. And what happened was that the Federal Reserve in the U.S. Took on a policy to reduce the interest rate. So in Hong Kong, we are affected in the same way, and well, pretty much the whole world, right, to different degrees, that the interest rates were generally decreasing. And you can see that by 2009, the overnight rates have been almost zero already. Okay, and that lasted until like 2017, right? And at that time, the interest rates grew back up to 1 or 2%. But then, recently the interest rates are much lower again, right? Because of the possible impact on the economy due to the outbreak of the coronavirus. Okay, so you can see that recently the interest rates have been very low again. All right. Now, so the not just the the percentage itself, right, but also the changes across time would be important if you want to analyze the economic trend. Okay, so here the trend in terms of the interest rate will have several purposes. Okay, so the first one, obviously, um, in the perspective of a company, then it might be useful to use the interest rate to model the cash flows. Right, the cash flows will be again a sum of money to be received or paid in the future. Right, so in order to be able to capture the correct changes, right, in that cash flow, as, as far as the timing is involved, right? So it will allow us to, allow the company to be able to calculate a profit, okay? So the profit might be calculated, or the income might be calculated with respect to some money that the company expects to receive in the future. And the interest rate will have an impact on the current value of a certain sum of money in the future. Okay? So that will help in calculation of the income. And for example, if you're talking about insurance company and, well, maybe banks as well, right? They need to hold some money as their reserves. Okay, so here you have the Chinese name, right? If that is easier to understand for you. Okay, so it's a sort of pool of money for the banks or the financial institution to to actually be able to um, meet the demands, right? If the market environment changes. Okay, so if it suddenly it requires more money, right, then having a good or a large level of reserve will allow the bank to remain solvent. And now the interest rate is also one tool, right, for the government or for the central bank to adjust its policy. Okay, so it is a sort of macroeconomic. Right? So economic policy, macro means is the big environment. Okay, so what happens is that if you lower the interest rate, right, that means for the borrower, he or she doesn't have to pay as much as interest. So in a sense, right, you are encouraging people and also businesses to borrow in order to invest, okay? And you are sort of trying to stimulate economic growth. So that's kind of like what we are encountering right now, okay? So it encourages investment. Now, on the other hand, if you think, if the central bank thinks that there are too much investment in the market um, that is above the desired level, then the central bank may want to increase the interest rate, okay, to encourage people to save rather than to take out even more loans. Okay, yeah. So this can be a tool, right, for the central bank to adjust its policy. And you can see that, so this graph shows you the monthly change in the interest rates in the same period of time. And you saw that in the first couple of years, right, the interest rate have been high and the changes have been relatively bigger, right, than in the middle years where it's almost zero. So there hasn't been that much of a change. But recently you are seeing those changes now. Okay, so interest rates are always changing depending on the economic situation. All right. Now, after talking about the sort of interest rate and the relationship with the economy, so we take a look at the different types of interest rates. So probably you have learned something on this already, but yeah, it's a good revision here probably. Right. So you have a type of interest rate that is known as simple and another type that is known as compound. Now, for the simple interest rate, it is always calculated based on the initial principal. Okay, so suppose you have a 5% per annum interest rate on $100, then you can see that it is increasing. The accumulated value. Okay, so here I'm plotting the accumulated value as a function of the number of years. So you see that each year I get a constant increase in the accumulated value, okay, under simple interest, and that is always the case. Now, whereas for compound interest, right, it means that after, let's say after 1 year, you get $105, right? So in simple interest, your extra $5 will not accumulate interest itself. But if it is compound interest, then that $5 will also be added towards your, you can consider your new principal, right? At year 1 would be 105. And that 5% is going to be accumulated on this 105, right? Now, over a short horizon, you probably don't see much of a difference. But as the number of years grows, then you see that, okay, compound interest is getting more interest to you in dollar amounts than the simple interest. And if you push forward the horizon a little bit, well, not quite a little bit, but quite far away to 100 years, then you can see definitely the difference is huge, right, between simple and compound interest, right? So whenever you come across with an interest rate, always ask yourself the question whether that is a simple or compound interest rate, because it could matter when the horizon is long enough. All right. Now we have also another way of classifying interest rates, which are the effective or nominal interest rates. Okay. So the effective interest rate is the actual amount, right? So it's the effective or the actual interest rate that you earn. Okay. Now you might not actually get the meaning of it right now, but when we compare to the nominal interest rate in the next slide, you will know better, right? Now suppose $1 principal produces $1.05 at the end of the year, then you have a 5% interest rate. Right, fair enough, right? Fairly simple calculation that I think you know already. Now, however, what happens if I'm using a compound interest rate, but the compound period is not every year? Okay. Now, so in that situation, then it sometimes might be useful to talk about the nominal interest rate. Okay. So consider this situation where interest is paid twice a year. Okay, semi-annually means you have an interest at the beginning of the year and maybe beginning of the second half of the year, which means let's suppose in July. Okay, now so if I'm quoting a 5% interest rate in this situation, right, then you have to tell me what that corresponds to. Okay, so in some situations, it is a nominal rate of 5%. Now what that means is that if 5% is for 1 year, then because I accumulate interest twice per year, okay, so each time I accumulate less amount, okay, so in fact it is a 2.5, okay, so exactly half of this. So if you pay 4 times a year, then it would be 5/4, okay, so it would be 2.5% every 6 months. And now in actuarial science, they will have a special notation for this, which is I bracket 2, which stands for the nominal rate per annum is 5%. And this 2 means that interest rate is payable twice a year. Okay. Now, if you are looking at this 5% nominal, right, then in this setting, it doesn't correspond to 5% effective, okay, because we are using a compound interest of 2.5 every half a year. Okay, so it's different from the effective interest rate being 5%, right? And the calculation is here. Okay, so you have $1 at the beginning of the year. So after 6 months, you get 2.5%. So you have 1.025. And then you take this amount to accumulate another half year, okay, at 2.5%. So after that half a year, you get 1.05 something else. Okay, so this is different from just 1.05. So the effective interest rate, if you take this amount and then subtract your initial principal, which is $1, and then, so you get 5.0625%, a little bit higher than your 5%. Okay, so if your interest rate is payable, or if your interest is payable more than once a year, then make sure you know the difference between the nominal interest rate, which allows you to get the per period interest rate easily, and the effective interest rate, okay, which reflects what you actually get after 1 year. Okay, so if you have a larger number of accumulations during the year, right, then difference of these two will be a little bit larger, okay, than in this case. All right. Now, so let's go back to the previous time deposit interest rates here. Now, so what are these rates? Do you think it is effective or nominal rates? Yeah, just take some time to think about this. So now, so I'll just give you the answer now, right, because the talk is pretty short. Now, so the answer is that it typically is a nominal rate. Okay. So if you have, let's say, 0.5, right, 0.5% for 3 months, then what happens is that I mean, 0.5% for a year, then for 3 months, you just take that and divide by 4. Okay. So basically around 0.125%, okay, per 3 months. So what happens in practice for most banks, I think, would be to calculate the exact number of days. Okay, so that will be the most accurate way. Okay, but roughly speaking, that would be whatever rate you have multiplied by the number of days in these 3 months, right, and then divided by 365 for the number of days in the year. But then the effective rate, right, could be a little bit different from those. Okay, so the difference will not be too large, but there will still be a difference. All right. Now, then we talk about something else, right? Some interesting aspects of interest rates. Now, so one question that is frequently asked is, okay, can interest rates be negative, right? If you say that it is an income for lending away money. Now, the answer is yes, right? So interest rates can really be negative, okay? And this is most likely as a result of a central bank's action. So it's kind of the interest rate um, they kind of use, right, for the banks to lend and borrow money. And this happens, right, if the central bank wants to encourage the other banks, right, the other commercial banks, to actually lend the money out. Okay, don't let so much money sit in the bank. Okay, so they are charging a negative interest rate in the sense that if you put in money in the central bank, right, then actually the bank charges them for putting the money inside the bank. So typically you would think that, okay, if I'm a commercial bank, I put some money in the central bank, I should get back a little bit of interest. But if it is a negative interest rate, then the reverse is true. Okay? And this is when the central bank doesn't really want them to put the money there. Okay? So they want them to lend out the money to businesses and to maybe individuals for their investment. And this has happened already, right, in Europe and in Japan. So these are the two examples where negative interest rates have been in practice for a while. Okay, and now another thing about the interest rate is now how we sort of talk about the lowest limit. Okay, can it be negative? So what would be the highest limit here, right? The maximum interest rate. Now probably you have heard about the saying, 9/13 So that means that if you borrow 100%, right? So let's say $1,000. So actually you get 900, right? Because the sort of loan sharks, right? They will collect 100 already, right? As the fees, right? The processing fees or whatever. So nominally speaking, you are borrowing 1,000, but the fact is that you get only 900. And the problem is that it is a short-term loan, okay? Really short, 1 month. So after that 1 month, you are supposed to pay back 1,300, okay? 1,300 in total, okay? So now 900 is the amount you get, right? But then you will have to pay back 1,300 after 1 month, right? So this is like almost 50% above your 900, okay? So this is a really, really high interest rate if you calculate or convert it to an annual percentage. And now it is a 30% on the original 1,000 or a little bit higher if you use 900 as your principal, right, in terms of what you get. And actually, if you do the calculation, you will get an interest rate or an effective rate, right? Recall that the effective rate is what you use to calculate the actual rate on the money you receive or you pay. So it is actually 2,200% per year, okay? And that is based on the 1,000 on paper, okay? But if it is based on the 900 you get, then it's even higher, okay? 2,488%. And the calculation, now, if you have 30% per month, I just talked about, and if you are just considering the nominal rate, right, then it will be just 12 times that per year, right? So it will be 360%. But the fact is that you are using compound interest, okay? So what happens to this loan is that if you do not pay, right, then this amount gets accumulated. It's not your original amount, right? So if you're calculating using compound interest, then $1 will actually accumulate to, if you are using 30% per month, actually 23.3 after 1 year. Okay? So the effective rate, if you calculate based on the amount you get at the end of the year, that will be 2,230%. Okay? If you are using the 0.9 or 900 as your principal, then you get an even higher interest rate. So this sort of interest rate is not allowed in Hong Kong, right? So actually, maybe some of you have, yes, I'm seeing a hand there. Do you want to ask questions? Oh, maybe by mistake. Maybe the hand was raised by mistake. Okay, so actually in Hong Kong, you may have heard about this. So whatever the financial institution or whatever the kind of borrowing is, it is only allowed up to a maximum of 60% per annum, okay, for the effective rate. So I don't care how many times, right, you pay interest during a year, but when you calculate the effective rate between at the end of the year and at the beginning of the year, then it has to be limited at 60%. Okay, otherwise it will be illegal. All right, yeah, but still 60% is pretty high interest rate. Okay, and I mean, if you allow your money to grow, or if you borrow money and you allow your borrowed sum to grow at this rate, then you'll find yourself pretty quickly in debt. Okay. Right. Now, so we talk about the interest rate, and here I want to talk about something on the relationship with inflation. Right. So inflation is 通胀. Okay. So the general increase in prices. Okay. Now, so here now the one thing about the interest rate is that they are quoted as the rate on the amount of money in terms of the current inflation. I mean the current price level. Okay. So this is what is known as a nominal interest rate. Now, there is a problematic thing here in the sense that this nominal is not the same as the previous nominal interest rate when we talk about conversion of interest several times a year. Okay, so here it's really nominal in sense that it is stated as a percentage of your current amount of money. Now, however, one thing is that prices are increasing generally through time, right? So in 1975, I think a hamburger sells for only this amount of money, right? Which is very cheap in today's dollars, right? But definitely not cheap in 1975, I believe, right? Whereas in 2019, it has grown to probably this price, right? So you see that there's a eightfold increase probably, okay? So this is the effect of inflation, right? General inflation as time progresses. Now, so in actual applications or in economic analysis, people would tend to also calculate what we call the real interest rate. Okay? Now, the real interest rates, they will adjust for the fact that $1 some time ago is not, I mean, it's different from $1 now. Okay, so $1 currently usually is worth less than $1, for example, 20 years ago. Okay? So after you account for inflation, right, then the sort of interest rate is the actual real, right? It's the real interest rate you get, right, with respect to, you can think of the purchasing power of your money, okay? Or in terms of hamburgers, okay? So that also works. All right, so the real interest rate in rough sense would be the nominal interest rate minus, so this is the quoted interest rate minus the annual inflation rate. Okay? So you can think that if the inflation rate is higher, right, that means even though you get the nominal interest rate, let's say 5%, okay, part of that 5% will be used to offset the inflation during the year, okay, and it's not actually, I mean, if you think about the increase in your purchasing power, the inflation rate is sort of working against, right, the increase in the purchasing power. Now, so I quoted some figures in 2018. The inflation rate in that year was 2.4%. However, the nominal interest rate was only 1.9%, okay, in a certain aspect. Okay? So in other areas, you might have a different nominal interest rate. But if I'm using this particular case, then you see that the interest rate I get is not enough to cover for the inflation for the year. Okay, so the real interest rate turns out to be negative, and in fact, the real interest rates can usually be negative. Okay, whereas the nominal interest rate I told you just now, it can be negative, but not very frequently. Okay, not a usual occurrence, but the real interest rate can really be negative. Okay, and this happens whenever the inflation rate is higher than the nominal interest rate. Right now, and this graph shows you the consumer price index, which is a sort of general measure of the price level over the years. Okay, so here you see 1981 up to 2019, I think. Okay, so see that the general price level is increasing in time, right? But you also see a period of decreasing. Okay, so in the years immediately following the um, the financial turmoil in 1997, right? So actually the inflation rate has been negative, okay, or the prices have been decreasing. And if you calculate the annual inflation rate, you see that, well, in this period of time, it has a negative inflation, or you can call it a deflation, okay, where the interest rate is negative. But generally speaking, it is positive, right? Now, and just now we talked about changing interest rates at the beginning, I think, right? So the effects on changing interest rate is kind of widespread in the economy. So it affects a lot of things in the general economy. So for example, the performance, right? So low interest rate typically boosts investment. You are boosting businesses in general. And in some cases, right, interest rate will also affect your exchange rate, okay? Especially now if you think about two countries using different currencies. Then if the interest rate in, let's say, country A increases, right, then that action could probably prompt people to actually buy the currency of country A, right, because of the higher interest, right? So they buy their currencies and then maybe put into the bank, right, so that they can get a higher interest. And that will affect the exchange rates between country A and other countries, okay? And now interest rate will also affect property prices, right? Because as you may know, right, in nowadays, uh, property or houses are very expensive in Hong Kong, right, and elsewhere as well, right? So people typically will take out a loan, right, a mortgage when they purchase properties. That means they pay back in installments. And if you increase the interest rate, then that means they will have to pay a higher interest, right, on the mortgages, and that might have an effect on the property prices. And also interest rate definitely affect stock market performances, right? So you it kinds of affect what type of investment people are putting the money in, right? Whether they put into time deposit or whether they would invest in the stock market, and how businesses perform as well, right? So that will affect, that will be affected by interest rates. And other economic measures or indices, for example, unemployment rate is also could be affected by a change in interest rate. Now, so here, actually, this one is a more in-depth topic, which I will not have time to go through today, right? But if you are interested, you can take a note at this word, annuity, okay? So just now, I mean, throughout this talk, I have been mostly focusing on that you take, you get money now and pay back later, or you uh, lend money else to other people and then you get back your money later, okay? So that is only one time, right? You only get money one time. Now, however, an annuity is a stream of cash flows at regular intervals. Okay? That means if you are receiving money, right, then annuity is a stream of money or cash inflow. Okay, so you are receiving a sum of money, let's say every month. Okay, so how do we calculate the value of this stream of payments, okay, at regular intervals? So definitely more frequently than annual, right? Just now I said you can be receiving money every month, right? And if you go to the website of the HKMC annuity, right, you probably know there is a type of product to the elderly people, right, where they can choose to purchase an annuity, that means they pay a lot of money right now in return for a sum of money paid to them at regular intervals, let's say every month until they die. Okay? So this is sort of the calculation. So how much they are actually getting, right, involves the calculation using the interest rates. Okay? So this is an annuity, and for those of you who are interested, you can search for this in online. And I think these are the closing slides, right? So in our department, there are 2 programs or actually 2 degrees or majors that will use interest rate very often. Right? So the first one here I listed, the program is in the actuarial science, right? It's the Bachelor of Science in Actuarial Science. So it is a standalone degree program. And you can see that there's a lot of courses you need to take, right? If you are in this actuarial science program. And in particular, there's one course, right, Stat 2902, which is financial mathematics. So in this course, you learn a lot more about how to manipulate interest. So how to make calculations on the accumulated value, the present value, and the different ways of expressing interest, as I mentioned to you. Okay, so one type is effective, one type is nominal. So in this course, you'll learn a lot more. And definitely, if you want to be an actuary in the future, then being able to describe and to adjust, right, your policies based on the interest rate changes will be a very useful skill. And then another major, right, would be in our BSc, right, in our BSc program. And this is a major in risk management that is also under our statistics and actuarial science department. Right, so this is just a particular major, right? You know, in our BSc, you are free to choose any of the many majors offered by our faculty, right? So this is one particular major. And now if you're doing risk management, probably you will be working in financial institutions in the future as well. Then there's one course, which is a core course, you have to take it, definitely. Right, so it's Stat 3615, which is on practical mathematics for investment. So pretty much the same thing. You will be introduced to the various ways of describing interest and calculating cash flows. All right. Yeah, so I think that's that for my talk. And yeah, thank you for your attention in this, well, pretty much 45 minutes already, right? So now, if you are interested in our program, I encourage you to go to our department's website, which is already put in the Zoom chat, but maybe for the people who have just joined, I'm typing it once more, okay, which is this link. So in this link, you will be able to see the details of the different programs, okay? And yeah, so I hope you, I mean, this talk sparked your interest in financial field, right? Or in our programs in risk management and actuarial science. And yeah, and that will be the end. Okay, thank you.